Episode 38. I am 38 years old. The recession of 1937 finally came to an end in June 1938, and in 1938 the Bank of Canada became a crown corporation belonging to the federal government. Beyond MD, episode 38, here we go! Hey everyone, Happy New Year, welcome back to Beyond MD. Today's episode focuses on investing in real estate development, and my guest is Sasha Cucuz, who is CEO of Greybrook Securities. So I know many of you out there have heard of Greybrook. So Greybrook is a private equity firm that focuses on real estate development-based investing, and they do have a focus in the residential space. So Sasha is responsible for leading the firm's capital markets and real estate investment strategies. Under his leadership, Greybrook's portfolio has grown to include more than 100 multifamily and residential development projects and over $30 billion worth of estimated completion value. Sasha co-chairs Greybrook's investment and project advisory committees, which are responsible for approving new acquisitions and actively managing all existing project partnerships. Now, for all the physicians out there, it's interesting to note that Sasha is also the former president of Greybrook Health. He played a key role in acquiring many companies and including the launch of Greybrook TMS, which is a leading provider of transcranial magnetic stimulation for depression. So today's conversation focuses on how real estate development works and also how the investment opportunities are structured. You'll notice that I don't ask a single question about returns. That's because I want listeners to understand how things work. Rule number one, you don't invest in anything you don't understand. So that's the focus of today's conversation. Now, one thing I will mention, on the day of the interview, we had so many technical issues. But what really stood out to me was how calm Sasha was throughout the whole process. He even took time to sit back and have a conversation. And honestly, it's when I see people like Sasha who have so much experience in the space, who are really respected for what they do, and their opinion is sought after, but they're so humble at the same time, that did leave a very positive impression on me. I also want to thank Barry McCullough for facilitating the interview. In full disclosure, I myself do invest with Greybrook to get exposure to real estate in a hands-off and passive manner. And with that, here's my interview with Sasha Cucuz. Hey, Sasha, welcome to the podcast. So where does the podcast find you today?
I'm in Toronto. I'm at the office. I'm one of the people that withstood the work from home thing. I have two young kids, so I came in kind of through the whole pandemic, and I'm still here. So our office is in downtown Toronto, Midtown.
So Sasha, your path is an interesting one because I heard about you on one other podcast, then I saw your hockey card. So I just want to know, how did you end up kind of coming to Greybrook? You're the CEO of Greybrook Securities. So maybe just talk to us a bit about your path.
Interesting path, I guess. The way I got into business. So I was playing professionally in the minor leagues. I was playing in the Philadelphia Flyers system on their East Coast Hockey League team, and I had tore my ACL. And when I tell the story, people are like, "Oh, you had a career-ending injury." I said, "No. I had a career-ending career. The injury forced me to think about what to do next." And there was a gentleman named John Herlihy who now runs the NHLPA's Life After Hockey program. At the time, he was working with the Players Union in the American Hockey League and the East Coast Hockey League, and he had the same program, the Life After Hockey program. And I got in touch with him after sort of rehabbing my injury and starting to think about different options for the future. Hockey was amazing. I had a great experience. But the writing's on the wall after playing a few seasons at the pro level and not moving up. You got to kind of think about the future. And for me, I got in touch with John, and he really helped me. I had gone to school. I got an economics degree, so I kind of felt like I wanted to do something in business. And John really helped me orient my search and introduced me to some people on Bay Street here in Toronto. My first job had nothing to do with real estate. I ended up at TD Securities working in their global Eurobond department, which had totally unrelated to real estate. It was in the bond area. But the way that Greybrook came to be is I met my now partner, Elias, kind of through a friend, and they were looking at doing, he was a healthcare entrepreneur, actually. So you'll notice if you look at our website that we do some things in healthcare. We still have a foot in the healthcare space, and that's because Elias, that's where he found his financial success. He founded a company called TLC Vision in the 90s it was a big commercial success. They did an IPO. He took some of that wealth and put it into a vehicle. Today we call it a private equity firm because we built a company around it. But back then it was a guy, probably not unlike a lot of your listeners, who had a corporation that he put some money into and was looking at good places to put it while still having a full-time job. He was still the chairman and CEO of TLC Vision.
This is where we had some technical difficulties. Sasha cut off, but nevertheless, we carry on with the interview. So Sasha, your journey is a very interesting one because I think it kind of shows that the path you start on may not be the path that you end on. And I have to say, as a sports fan, I wanted to hear your hockey past. I don't like the Flyers. I've been a lifelong Penguins fan, so you can understand the rivalry there.
It's funny. I'm on a board with Brian Burke, who's the president of the Penguins. So
no
it's
way. No way.
It's great to hear some of the backroom stuff that goes on and stuff like that. It's an exciting business for sure.
That is fascinating. So, Sasha, you mentioned healthcare investments. I know we're going to talk mainly about real estate today, but that just made me think of something because I often tell people, if you're going to invest in something, it's imperative that you understand the nature of that investment. And as healthcare professionals who are the main audience for this podcast, sometimes they may have a better working knowledge of investments in healthcare. So the investments that you guys do in the healthcare space, is that open to other investors today or not?
From time to time, the strategy we have there is a bit different. In the real estate side of our business, on the real estate side, it's all our own capital, obviously, but third party equity.
Yeah.
On the healthcare side, because the risk reward isn't quite the same. Like, we feel very comfortable investing people's money in land, for example, or the things that we do in development. The primary client base we have are individual high net worth investors. A lot of times, there isn't that many people that are suitable for the higher risk stuff.
Yeah.
And the healthcare stuff we get involved in is pretty early on, right? So we get involved very early. We focus on device healthcare services. And so from time to time, like, I'll give you an example. We took public a company called Greybrook, which is a mental, they actually manage a network of mental health clinics. There's about 200 locations across the US. We started that business from scratch. Like, literally, I was kind of co-CEO for the first few years of that business. And then when it got to a point of maturity and it was ready, kind of de-risked financially, we let some of our investors from our broader network invest in Greybrook prior to the IPO.
Gotcha.
So from time to time, we'll do things like that. And when we think that the risk reward is appropriate, we'll open it up to some of our investors.
Gotcha. So if I go to your website today, I see Greybrook Capital, Greybrook Realty Partners, and then Greybrook Securities. Can you just kind of summarize how the different types of your business all kind of intertwine?
Yeah, absolutely. It can be a little confusing because there are different regulatory considerations. So Greybrook Capital is for all intents and purposes, it owns everything, and that's owned by myself, Peter, and Elias, my two partners. Below that, you have Greybrook Realty Partners, which is our asset management business. It's primarily responsible for actively managing all of our existing developments. And Greybrook Securities, because we're regulated across Canada and in the United States by the securities regulators, it's primarily responsible for the diligence and capital considerations, right? So putting the investors together, the offering memorandums, and all of the regulatory pieces. So for all intents and purposes, it's run as one company, right? Yeah. Peter and I are the two active CEOs, but we separate them from the perspective of, our regulatory and legal obligations.
Can you, Sasha, give us a quick overview of the types of real estate projects that you're taking part in now? And also, I'm curious, how many projects do you have on the go and what your main markets of focus would be?
On the go, we are actively managing over 100 developments.
Okay. Wow.
Actively.
Wow.
So as if we were a developer, we'd be the largest in Canada, maybe North America wide. I don't know that for sure, but certainly in Canada. We're not, though. We're a financial investor and we partner with the developer. So the way that our investments work is our focus. We like to be involved specifically in development. So we think of our investment strategy as being in the manufacturing of real estate rather than the consumption of real estate. Like when you buy an apartment building or a plaza, you're benefiting from sort of long-term capital appreciation and the cash flow along the way. We're thinking, we think of ourselves as the guys who build the widget. So we make our money on the margin between what it costs and what we're selling it for. And we will partner with a developer in every instance. So we will, we put our capital in place. We will joint venture with a developer. We will co-own the development together. So we're not a lender. We're not lending anybody money. We're an equity owner, and we get all the benefits and upside of that. We also bear the same risk. And we will have an execution partner in every case, that being a top tier developer. And we'll talk a little bit about what we look for specifically, but we'll joint venture. And that joint venture has an agreement between us, the money, and the developer on who does who's responsible for what, and how our relationship works together. And the thing that I would say I'm most proud of who we've become is we've gone from, in the early days, just being a check, right? The money guys, to really understanding development at a very detailed level, to the point where in most cases, we're co-managing these developments together with our partners. So what that offers investors is 2 layers of top tier management, both the developer on the ground and us, and the role we play in bringing decision making, perspective, collaboration, and all of what is required to make a development successful. Our areas of focus are North America for the most part. We have a very heavy presence in Southern Ontario. We have a specific investment thesis around that. And in the US, we build a lot of rental housing kind of across the country in select markets. So some examples of those markets would be South Florida, Fort Lauderdale, Miami, places like Denver, growing areas that are a great opportunity. Atlanta being another, as well as some others. We're looking at Charlotte, North Carolina at the moment. But that strategy is, I think, in the US a little bit broader geographically, whereas in Canada, we tend to focus on Southern Ontario.
Yeah, and we will get into your Southern Ontario investment thesis a little bit later on. One thing, Sasha, so let's just dive right into the project now. And maybe you could take us just in broad strokes from start to finish, because I don't think a lot of listeners, at least myself for a long time, I didn't really understand how developers make money on a project, and then therefore how investors make money on a project. So starting maybe with the piece of land, start to finish, how is money made on a project?
So we think of it in kind of 3 compartments. So the first thing obviously is land acquisition. So as I mentioned, we co-own the land. So from an investor's vantage point, when your money goes into one of our investments, and I should mention, and this is a bit tangential, but particularly for your audience, because this style of investment is active investment as far as the CRA goes, right? So when somebody uses a professional corporation to invest with us, it's active income on their part, which is a more efficient type of investment income than a capital gain would be, for example, or a passive investment strategy. But that's a bit of a tangent. When the money goes into one of our vehicles, that vehicle will buy the land together. And that's step 1. And I would argue that is probably your most important step, because in development, land value can vary widely based on what you can ultimately build on that land. So if you think of 2 pieces beside one another, one of them might be, eligible for 25 stories and the other for 50. Those are going to have drastically different values, because obviously the 50-story building should have more revenue, more profit, yes, more cost, but also a greater total dollar yield. So you have to be very, very picky about what you're buying and understanding the planning environment to be able to purchase appropriately and not overpay for that land. So that's step 1. We will put our money up. Usually we are 80% of the equity, that being Greybrook and its investors. The developer will put up 20% of the equity. So it's a disproportional equity contribution, but the developer is responsible for everything from that point forward. Once our money goes in, we own the project together. The developer is responsible for all the execution along with us in that process, Greybrook. Most importantly, they're responsible for everything that you need in a development. So to get back to your question of how you make money, Well, land is only one component. Next, you need to build a building. Let's use a condo as an example, right? So the way it works here in Southern Ontario is I have my land. I'm going to spend some money on what we'll call soft costs, right? My architects, my designers to be able to kind of bring a building or a vision to life. Then I will go out and spend some money on sales and marketing to sell my units to the public. Once I've done that and achieved a certain threshold, usually it's about 70%, I can go to the bank and say, hi, Mr. RBC, I'm here. I have a viable project. I have 70% pre-sales. I own the land. I'm fully approved and zoned. And my total cost is $350 million. RBC will lend you usually about 65 to 70% of that total cost in the form of a construction loan.
Okay.
And that is something as well that our developer is responsible for procuring.
Okay.
They're responsible for providing all of the guarantees opposite that lender, which is a huge financial obligation that our investors are not subject to. And then you go out and you build a building. And the people who bought at the point when the building is completed, they'll come in and take their units, they'll close on them. And at that point, we realize the overall revenue that's from all the people closing. So now you're left with a whole bunch of costs funded by way of equity and a construction loan. You built a building, the people come in and close on it, and now you pay off all those obligations and you're left with your profit at the project level.
Yeah.
From that profit, the way the money flows back is 80% of the cash comes out first to us, the investors that went in. 20 cents of that dollar go back to the developer until everything's been repaid. And then from there, there's a profit split. 45% goes to the investor, 45% to the developer, and 10 to Greybrook for its role. And that's primarily how we're compensated in these developments. The question I always get is, well, if I'm putting up 80% of the money, why am I only getting 45% of the profit? Right. Which is a logical question. The answer to that is, success is all in the execution, right? And you're relying on the developers to execute successfully. They're taking a considerable amount of financial risk that we are not taking, and that's by way of guaranteeing construction loans that are hundreds of millions of dollars. Also, if there's ever any cost overruns that happen, construction costs go up or whatever the case may be, our capital, once it's gone in, we own what we own, and it can never be diluted, and the developer has to put up the money to fund those overruns. So they're taking a considerable amount of financial risk off the table for us. So the example I always give to people is like, if I wanted the biggest and best developer that had $1 billion lying around and said, hey, I got a great deal for you guys. We'll put up the money 50-50. We'll split the profits 50-50, except you do all the work and sign opposite the bank on all the guarantees. And if there's any overruns, they're on you. If the guy has $1 billion lying around, he's going to say, what the hell do I need you for? Right? So you have to come up with a structure. Yeah. The only guy you're going to get in that instance is the guy that doesn't have the other 50% of the money. And usually that's not the guy you want to work with. So the quid pro quo is that there's a structure that offers an incentive to these large scale developers because it makes it a good financial investment for them. And at the same time, us as investors are getting that top flight execution and a balance sheet that it can actually support all of those financial obligations. Because it's one thing to say, yeah, no problem, I'll put up those guarantees. It's another thing to actually have the financial capacity to do so.
Totally logical, what you're describing there. Now, Sasha, some people who get introduced to these investment opportunities, the one thing they'll be told is you will invest in a limited partnership structure. I know it's a basic term for some, but for some it's new. So what do we need to know about that term, investing as a limited partner?
Yeah, so a limited partnership and being a limited partner is a very efficient way to invest typically because what it means for the individual is that your liability is limited to the dollars that you put in. So no differently than when I buy shares of a company, theoretically, if that company does something wrong or gets sued or whatever the case is, myself as a shareholder, my liability is only in insofar as the equity that I put in. But the other benefit that a limited partnership has is that it allows, it's a flow through, as we call it in our business, right? So if I'm investing in a corporation, the corporation pays tax, and then, I'm then entitled to a capital gain when I sell the shares, or maybe a dividend, and there's a different tax treatment. The limited partnership is a full flow through. So it basically flows through the tax liability straight to the investor. And that doesn't sound great when you say it flows through the tax liability. But what it's doing is it's allowing the investor to manage that liability to a level that's most efficient for themselves individually. So if you think about most of your listeners who are would have professional corporations, you have income coming into your professional corporation. Some of it you use for your expenses. The other, will be used for making investments or whatever it is that you'll be doing. This is a very efficient way to invest because essentially what's happening at the project level, if you think about it, is we're buying land. We're spending a bunch of money, right? You're spending money on soft costs, your hard costs. So the partnership is realizing a loss for the first several years on a tax basis. Those losses flow through right to you, the holder of that professional corporation. So you can actually use those tax losses along the way.
Okay.
And then again, at the project level, when the revenue comes in, that's when you're realizing your profit and the gain. Ultimately, that loss is recaptured. So it's not a tax deduction, but it's a tax deferral. And it gives you the ability to manage that appropriately and very efficiently to the individual without any additional liability, right? So it's kind of the best of both worlds in that sense. Obviously, for professionals that are investing that aren't tax experts, most of whom aren't, you should talk to your
of course,
advisors,
yep.
but essentially it's a very efficient way to invest, particularly for people who have corporations they can use.
So let's say if you're investing through your corporation or a holding company, my understanding is, let's just keep the numbers simple. If you put in $25,000 into a project, which I understand is often the minimum,
Yep.
Which is a very reasonable minimum. If you invest $25,000, let's just say at the end of the project, if the returns are 100%, if it turns into 50,000, then that gain, I guess that's treated as business income in many cases, right?
That's correct. In every case. Yeah.
The other thing I wanted to ask you talked about getting approval, getting zoning done. So let's say in the GTA, if you're taking on a project, what is the time frame from saying, hey, I've decided with a developer to take on this project to actually hitting the ground and getting the work done? Because I understand that there can be some roadblocks, let's say in the GTA compared to other markets in North America. Can you comment on that?
Yeah, the roadblocks are many. The first part of how I answer this question always makes people cringe, and they're like, why on earth would I ever want to invest in something like this? But the way I generally finish off is there's good news. The good news is if you know how to do it, there's a lot of barriers to entry, and it's very difficult to do. And that obviously gives you a great position. And also, if you think about what we live in, notwithstanding the particular, set of conditions out there today, which we will talk about, I'm sure, later, but generally speaking, the upward trend in pricing around housing in the GTA and the Greater Golden Horseshoe is as a direct result of the scarcity that exists when you have a large and growing population opposite a very difficult planning and approvals environment where things often take longer. They're often encountering complexity and opposition. And as a result of that, you can't keep the supply up to meet the demand. And that gap, that scarcity is what's pushing up pricing to such a level. And the GTA and sort of Southern Ontario, I'll expand it, has a lot of constraints when it comes to development. There's some physical constraints. Obviously, we have a lake. Can't build on the lake unless you're building Atlantis. Everything around it, we're surrounded by a green belt. And that green belt essentially encircles all of the developable land. And that green belt is there for a variety of reasons, obviously some of which are environmentally driven. The others are really centered around how communities need to develop on a sustainable basis when your population base, for example, isn't as dense as a California or a New York or a Florida or whatever that may be, right? Like some of those places have more people in their state than Canada does as a country or close to it. And as a result of that, we have to really be careful about how much urban sprawl we allow, because the cost of that infrastructure is very difficult to maintain over a more sparse population. So the result is that green belt forces us into intensifying the lands that are already serviced and where the infrastructure is readily available. So it's a difficult process. There's no question. But that's where a lot of the value is created. So for an investor, oftentimes they'll see us buy things that are not yet approved. And the reason we do that is because there's a lot of margin that can be created buying land that's what I'll call raw, and going through that process that I just sort of alluded to, where you're taking it to ultimately a final approval. But those steps in between, where you're working with planners and municipalities, and you're dealing with the community stakeholders, right? Whether that's people who live in the neighborhood or businesses in the area. It's a highly political process. It's a highly public process. And it can be painful at times, but that's where all the value's created. That's why the land, at the end of the day, land prices have been so high, because if it was as simple, and we do some work in Texas. I'll give you the flip side of the coin, where in Texas, more or less you can get an approval inside of 6 months.
Wow.
And it's not that difficult to process. Generally speaking, they have a master plan, and if you conform to that master plan, you could pretty much build whatever you want, with the exception of some design review committees and people that kind of weigh in on some of the peripheral things. Well, what that means is when you have a growing population, you can also build just as quickly. So as a result of that, you're not seeing the same upward pressure on pricing, because supply is more or less meeting demand. And that also comes with a set of risks, because if all of a sudden that trend on the demand side reverses itself because people don't want to move to Houston, it's even a good example in terms of, the energy sector isn't as favorable today as it was 10 years ago. So some of these places in Western Canada and places in sort of the Western United States are having net outflows, not net inflows. And if they built more housing than they need, they're going to have a lid on pricing for a very long time, because supply is going to exceed demand. Here in the GTA, we have the opposite problem, and it's not very easy to address. So even in a set of circumstances that we're living in today, where interest rates have gone up, and you've seen, buyers stop and sellers stop, and, the market's more or less at a standstill and prices have dropped. I see this as a temporary dislocation, because that fundamental dynamic between that gap between how many people need homes on a growing basis every single year versus how many we can produce as an industry because of all these barriers, that's not changing. And once credit conditions stabilize, you're going to see things, jump right back up to where they were over time. And I'm not going to forecast whether that's a year or 2 or 3, but the point is that I have no concerns over the long-term health of this market because of that scarcity and how difficult it is to actually, do anything. And I always ask the question, everybody's done a home reno or something, or not everybody, but a lot of people. You try to cut down a tree and it takes you a year between, now imagine building a 50-story building or a, 400 unit townhouse development. And you can, usually when you draw that line to people, they're like, yeah, okay, that must be pretty complicated.
Okay, perfect. I think you went into great detail there on your thesis long-term, especially when it comes to the GTA. Obviously, sounds like the long-term outlook in your eyes is quite positive. Now, Sasha, how do you guys select a project? Because I see a lot of cranes in the sky, and it's interesting. I actually ran into there was another dad at a birthday party, and then he started talking about developers. He mentioned Greybrook as well, and it became apparent to me that you probably partake in a very select number of projects each year. And you talked about margins. So, what are the margins on each project? And then every project is going to have a certain risk profile as well. But can you talk about how you guys select a project, the underwriting, some of the details there?
Yeah. So it starts first, obviously, the macro thesis we've covered off in terms of the types of things we buy and where. The next thing is obviously understanding the micro, which is the property that you're looking at. But I think more importantly than anything, it's, bringing the right partner in place. And I can't stress that enough, because you're going to see, and I guess behind the cloak of development, let me help contextualize for you. We've seen a great market, right? A tailwind for 15 years. The amount of people that have lost money being developers over that 15 years would blow your mind. So clearly, it's not just the rising tide floats all boats. You have to understand how to move forward and how to manage your risk. So for us, it's all about risk management. So it starts with your acquisition and making sure that you have the right structure in place. Because in development, as I mentioned kind of off the top, we're in a margin-based business. Okay, so we have certain parameters, and it's generally around a 20% margin on cost at the project level. But to put it to you this way, margin exists in both up markets and down markets, right? So you're not always relying on the forever appreciation of housing in Toronto. Mm-hmm. Let me give you an example. So today we're living in a universe where costs have gone up as a result of the pandemic, supply bottlenecks, a lot of strain on the building materials and labor sector. So you've seen a big jump up in cost. Mm-hmm. And now we're in a period of time where, in response to that inflation that has driven up costs, you're seeing interest rates go up, and that's tempered the buyer activity. So all that means is that for the next year or 18 months or 2 years or whatever the case may be, you're going to have comparatively less units sold than you did the prior 2 years. Mm-hmm. Well, that also translates into less units being built, which takes a lot of strain off of the infrastructure. So then you're going to start seeing costs cool off. And that means that margins get restored, even without that price appreciation. So for us, it all comes down to being able to stay in the game, as we say, which means you have to structure your buy in a way where you have not over-leveraged, mm-hmm. right? And you're adequately capitalized to be able to, in the worst of scenarios, sit there and say, you know what? I'm just going to sit and hold it. I'm not going to release my units for sale because the market conditions are not supportive. But you know what? I can hold it for a year. I can hold it for 2. I can hold it for 3 if I had to. And I'm not going to get hurt. And the way that people hurt themselves is they'll buy sites, they'll overpay at times because they're aggressive and they want to kind of, break. Market's great. I can pay a little more. We never do that. The other thing is leverage, right? I can go out and buy a site and put 80% expensive mezzanine debt on it, or, I can go to a third-party lender or Uncle Vinny and wherever, and he'll lend me money at 19 points. And I can reduce the amount of equity I have. And if things go well, I can maybe make a better return on my equity. But at the end of the day, if things turn and now all of a sudden I have a big loan ticking at a high interest rate, I don't have the same ability to wait as somebody who bought it with a moderate amount of leverage or no leverage. And so what that means for us is on that acquisition, that makes or breaks your ability to wait it out. And what we say in development is oftentimes your big enemy is time, not so much an erosion of your capital if you've structured yourself appropriately. So from that acquisition and its structure, that's step one. And then beyond that, as we talked about from the beginning, it's all down to the developer making sure that you have not only somebody with the right execution and history and, they built more than a building, but also they have a large balance sheet because it is a very capital intensive business. Costs can ebb and flow. Banking regulation can change. And you need somebody that has the financial wherewithal to be able to stand behind the contracts they've entered into. Because, it's one thing to put it on paper. It's another thing to stand up and say, yeah, great. I know I'm obligated to put the money up, but I don't have it. What are you going to do about it?
Right.
So that's a very important thing. So I would say that those two things are the most important risk mitigants from our perspective.
That's really helpful. So you mentioned also in that answer, rising interest rates and then commodity prices. They obviously were very high in the pandemic, maybe starting to moderate a bit. But is it safe to say that the combination of those two things, Sasha, has made the cost of development quite high? And my sense is, if that continues to persist, whether it continues for 12 months, 18 months, we don't know. Doesn't that further constrain the supply, therefore strengthening the long-term investment thesis? What are your thoughts?
I'm surprised to know that you're a doctor and not a investor. I think you've hit the nail on the head in the sense of the long-term implications of what we're going to live through for the next little while are probably going to be pretty profound. In the sense that if you look at what's happening at a policy level, we're not slowing down the amount of people that are coming into Canada and de facto into places like Toronto. That's accelerating. Mm-hmm. And at the same time, the current conditions where, as you mentioned, costs have increased. Like think about if I'm sitting there today and I just bought a piece of property 6 months ago. Mm-hmm. I'm now in an environment where my costs have gone up, probably higher than they have in the past. And there's a very predictable reason as to why, or, and it's evident as to why that's happened. So it's not like, oh my God, how did this happen? I mean, we've had a global pandemic and all of the pressures that have been associated with that. And we're living through this high inflation. And then as a policy response, interest rates have gone up to ultimately cool what you're seeing on that cost side. But with that comes a restriction to those buying assets today, right? Because you can't access mortgage capital to the same extent that you could a year ago or a year before that. So you're living in this very strange time where my revenues are essentially not increasing, and I didn't say dropping, because it's important to make the distinction between the pre-construction part of real estate and the resale part of real estate. Because if in the resale market, mortgages today and what's happening with interest rates today are much more relevant, because I'm buying a house, I'm closing in 60 or 90 days, and what's happening today matters a lot. If I'm buying a condo unit, for example, in pre-construction, I'm taking delivery usually in 4 years or 5 years. So like today's interest rate environment is less relevant than my outlook over the next 5 years, right? Because I don't have to take a mortgage today. I'm getting it in 5 years. So what you've seen is a lot more price stability on the pre-construction side and less price stability on the resale side. So we're living in a period of time where if I'm selling today, sales velocity, which is different than price, has ground to a halt. Why are we seeing price stability? For the most part, developers have said, why would I sell into this hailstorm of a market? I'm just going to hold on, and I'm not going to release my inventory. I'm just going to wait it out. And that is restricting the amount of future supply. So to your point, what I think we're going to see is for the next, call it 2 years, a period of time where you're going to see far fewer new units come to market than historically are required in any given year, right? And what that's going to do is further restrict supply such that when credit conditions improve, and now all of a sudden people, inflation's come down, interest rates come down with it, probably with a recession somewhere in between. But the odds are that interest rates will be lower tomorrow than they are today. And when people can now resume getting back into the market, you're going to have a pent-up demand because it's not only people sitting on the sidelines, it's all new people coming in every single year who need housing, whether that's housing to rent or housing to buy. It all comes from the same place. And this bottleneck that we're going to live through today, because the conditions between cost and revenue are not supportive, is just going to further cut down that supply. And then you're going to have a pent-up demand that at some point when it can return to the market, it'll be, I don't want to use the word explosion, but there's going to be, it's like lifting a gate and all of a sudden you're going to have a whole bunch of people rushing through.
Yeah, I think there's a lot of truth to that. I think a lot of people are looking at it that way as well. Sasha, I'm just trying to get a sense of my audience. We are in many ways moderate risk. We like to control our risks where we can. So I'm just trying to get a sense of, with any projects, I don't know if you're able to share an example. Obviously, the unexpected can happen, and I'm just trying to get a sense of, you've talked about mitigating risk, but what about exit strategies? Like, was there ever a time where things just didn't go to plan for a project and you had to pursue an exit strategy? I'm just wondering how you navigate these scenarios.
Yeah, so it happens. I would say that it's not, thankfully, the most common occurrence in our history. That's 18 years long today. There's probably been less than a handful, maybe one or two projects where things didn't pan out the way that we ultimately wanted to from a financial perspective. They very rarely go exactly to plan, and that's even in the best case of scenarios, right? Because as we mentioned, there's a lot of unpredictable things in planning, most of which are time related. Like, we just lived through COVID. Well, there was a period of time where COVID knocked a whole bunch of, people out of the workforce, and cities were short staffed and there were no planners, and, advancing applications was very difficult. So it's unpredictable, but at the same time, we manage risk in a few different ways. Like, number one, and I'll say, to your point on exit strategy, we are not a developer. And why that's important is because we are not compelled to build anything. We're compelled to generate the best risk-adjusted return for our investors. Sometimes that means building it. Sometimes that means selling the land. even in the upside scenario, not just to preserve our equity, but rather in the upside scenario of, wow, we made a whole pile of money just on getting through zoning and approvals because the market, there's such demand for this type of land. We could exit, double our money, and not even take any of the risk of construction and whatnot. So I would say that the way that you mitigate most risks is to allow yourself the greatest amount of flexibility in what it is that you do. And again, that comes with being a private equity investor and not a developer. And I'll say this, and this is not, for any other reason, but to just illustrate the point. If you invested money directly with a developer whose entire infrastructure consists of construction people and people that go through and do sales and marketing on projects to sell units, well, the odds of them selling every piece of land, even if they made a profit, and just having 80% of their infrastructure sit there and not do anything, they're not in that business. They're in the business of building homes or building condos. So you're not going to have that versatility, whereas we come in and we look at it at every stage and say, okay, well, are we a buyer today or are we a seller today? We've got our approvals. What would it be worth in the market if we sold it versus going through with our program and buying it? Is there an advantage to selling it today? So we can look at it. We have that versatility. The second thing is structure and mitigating that risk. Because as I mentioned, if you've bought your land well and you've not over leveraged yourself, you can generally manage most of the risks because time is the cure-all. And I don't say that in a blind faith way. It's because of that scarcity and that fundamental imbalance that exists. So I'll tell you that the minute credit markets are supportive again, you will have a lot of people re-enter the market. Why? Because they fundamentally need to. It'd be different if we were a city like, a good example of this is Las Vegas in the financial crisis. And I'll use a U.S. city just to illustrate the example. But it wasn't a growing city. It happened to be growing because, times were good and things were great and developers had no barriers to entry. You could be a national developer and say, hey, Vegas is a great market right now. Let's go out and build as many homes as we can because we can make hay. Well, guess what? When conditions changed after the financial crisis, it took Las Vegas 14 years to get back to its 2007 level.
Wow.
And that was simply because supply outstripped demand. They had built so many homes, and then when the city stopped growing, because there was nothing bringing people into the Vegas area, they actually had flat migration or net migration outward. They had more houses than they had people. So of course you're gonna have downward pressure on pricing, and it took them a very long time to get back to where they were. For us, again, a credit disruption, just like it was in '08 in the US, but we're having a credit disruption. The only difference is that we have way more houses needed than we have houses available, new or existing. And that is going to create a dynamic such that when conditions are more supportive for mortgages, you will see a re-entry into that market. So the question there is always time. So how do you protect yourself? You got to make sure that you can, as we say, we joke around, it's like you got to be able to live to fight another day. And structure is the only way that you can accomplish that. Because again, you can go out and you and I could buy the same piece of property very differently based on how we structure that deal and how much leverage we decide to use.
Now, as we wrap up, Sasha, just a quick note on developers, because I talked to people throughout the pandemic who were investing in projects, and it may have been a high-rise condo project, and one of two things could have happened. In some cases, the project just stalled, and so people lost out on time in terms of growing their money. Or another scenario that came up was they were hit with some unexpected fees. And so automatically when those things happen, you start to hear things like, I can't believe the developer did this, or bad developer. But then on the other hand, you talk about being partnered up with some of the best developers. And these developers, they have often many projects in the go. They have a very good reputation and a reputation to protect. So it creates a bit of a spectrum where you have some people saying, I can't believe the developer did this. But at the end of the day, they have their reputations at stake. So could you maybe just help us understand this narrative a little bit more? Because it's very polarizing to me.
Oh, yeah, for sure. So the first thing I want to point out is it sort of also depends on how you're participating in development. So if you're the one buying a unit, you are bearing different risks than the person investing in the actual development, right? Because at the end of the day, as you pointed out, projects have been canceled, and the person who bought a unit is sitting there saying, well, I'm just getting my money back, maybe with some nominal interest. I missed out on all this time. So if I was actually somebody who was buying a house to live in, not an investor, I missed out on all this growth, and now can I re-enter the market? Like, it's a really crappy set of circumstances for that individual. If you're invested in the equity of that same project, in most cases, the project that got canceled, that equity, which would be kind of our side of the equation, still made money, right? Because at the end of the day, the land, the reason it got canceled is because they can't build profitably at the price they sold at. Mm-hmm. And the result of that is that they just unwind it. They give people their money back. And then whether it's a week, a month, a year from that point in time, they'll either sell the land to somebody else who can restart a sales program and sell at a higher price, or they'll just wait and start selling it at restart it under a new name and start it with a new project. In both cases, the equity probably did pretty well there. The person who bought the unit didn't do very well. Now, it's not a good scenario. So let me start with whatever side of the equation you're on. Even if you're on our side of the equation, you never want to have this type of scenario. And you, I think, characterized it very well. The larger developers who have many other projects and have a generational brand, they can't think about just this one project, right? They have to think about their reputation. They have to think about the things that they want to be in business for many, many years. Whereas some of these smaller developers might have, this is my one project. And, if it's not profitable, then I can't, I'm not going to be able to continue. But even in their defense, the narrative out there, at least in the public, I think has been a little mischaracterized. And it often is a much better headline grabber to say, big bad developer wasn't making enough money, and then they either canceled their project or they went back and they asked their buyers for more money. What an evil human. That's generally wrong. And I'll say it. It doesn't matter if you're big or small. What's happened is that the time between pre-sales, usually, so you go out there and you sell your inventory and you lock in your pricing, and then there's generally a period of time before you can start building it, and that's when you go out and tender your costs. It's been very volatile out there. So I think what a lot of developers have seen is that they locked in their revenues at a point where, had they started construction that very second, it would have been a profitable development. And then maybe they didn't have all their approvals in place. Mm-hmm. Maybe they were missing some of their permitting that then got dragged out. And then lo and behold, they're starting to build it 2 years from the point they sold, or a year and a half, and costs have gone up 15%. And now they're sitting there with a project that doesn't have the margins required to get the financing. And that's the key here. It's not a question of the developer being greedy. Mm-hmm. It's a question of the commercial realities of lenders and the proportions and ratios that they're looking for. And they're saying, hey, you know what? You don't have enough margin in your project for me to lend you the money. I'm not comfortable lending you the money. And then these guys are left without their financing, and they have no choice but to either improve their margin. And that's where you've seen some of them go back to the buyer and say, hey, listen, kick in another 50 grand and you can have your unit. And by the way, your unit's 300 grand in the money. Yeah. So you still win. Yeah. I can get financing and we both win. That doesn't go over well in the public, obviously. Mm-hmm. And then the other thing is, okay, well, I guess I just got to cancel the project and unwind it because I can't get my financing. So the way that you mitigate those is twofold. One, working with the large developers as we do of what's required from an approvals and permitting perspective before launching sales. And sometimes it's hard to resist the temptation when you're ready with your sales and marketing program to go and say, okay, the city thing, yeah, it'll take me 9 months or 10 months, but I want to give myself 9 or 10 months to sell my inventory, so it should match up. And then the market's really great, so I want to go out there and take advantage of it and sell all my units. So developers sometimes have made that decision, and what happens is it doesn't take them 10 months to sell out. It takes them 3 months to sell out, or 2. And then that city process that they thought would take 9 takes 18. And now they're upside down because costs have moved differently and they're in that position that we just talked about. So the way that you mitigate that risk, and this is something we focus on in all of our projects, particularly on the low-rise side. We talked a lot about on the high-rise side, but on the low-rise side, a lot of times when you're building new communities, you have to service the lands, right? You have to bring all the waterworks up. You have to build the roads. You have to do all these things, and that requires collaboration from the city. So we don't even launch things until they're serviced, because you can encounter all kinds of different delays. And if you've been too eager to take advantage of a good market, you could find yourself upside down. And that's something that can be mitigated just by the timing of when you launch sales. And believe me, it's easier said than done, because when markets are good, developers are generally like, hey, this is the time where I got to go out and do it. But at the same time, you got to be patient, because it can hurt you in the end. And that's something that, we make sure that we don't allow to happen.
So, Sasha, last question, hopping around here a little bit. We've talked about markets like the GTA. We've talked about Florida. And I think the two things that these areas have in common is that there's a very limited amount of land to develop. And it seems to me like a lot of people have a bullish view on these markets. But what I'm wondering is, was there ever a time where you had to pursue a project, or you pursued a project with maybe a bit of a contrarian view, looking at markets where people weren't looking, and perhaps these ventures paid off for you? Or are you looking at certain markets where maybe they're undervalued, underhyped, a lot of people aren't looking in that direction, but you're thinking as a bit of a contrarian? Because this could be really difficult to do, because I tell you, when I invest, I'm often following the herd. I'm looking at headlines, I'm doing what other people are doing, but I think sometimes it could pay off to take a bit of a different approach. And I'm just wondering how that falls into place for you guys.
I wouldn't be too hard on yourself. I think what you're describing is very difficult, right? And we have 90 people that work here, and all they do is go through data, and we have our own forecasts, our own opinions on where interest rates are going, and it's not based on what I read in the Globe. Let me answer the question this way. I learned a very valuable personal lesson in 2008. Okay, I had TD Bank stock and CIBC Bank stock, and in 2008 happens, the financial crisis. It wasn't as bad in Canada as it was in the US, but I'll tell you and refresh everyone's memory, it was pretty bad here too. And you saw a lot of the banks really take a pounding, right? CIBC stock went from $90 to 30. And I remember at the time there was questions about the solvency of TD and CIBC and all, are these banks going to survive, right? They have a lot of exposure to the US and whatever the case may be. And I hit the sell button, because you panic, you get emotional. At that time, it was a lot of my savings, and I was like, oh man, these things are going to go bankrupt. And then you sit there years, and you're like, how on earth did I think that CIBC was going to go bankrupt? What was I thinking? I should have been backing up the truck and buying at $30, not selling at $30, right? But that lesson was a valuable one, because the way that we think about it, to give you a real life example, you ask, have we ever gone against the grain? Well, we bought a bunch of things downtown last year, or through between 2020 and 2022, future condo sites. And believe it or not, people were like, what are you doing? Toronto, cities are over. You never have to go back to an office again, and you're going to work from home, and you can go live in Uxbridge, and life's good. And I was like, that's preposterous. If you think cities are finished, whether you work from home or not, human beings and their propensity to congregate, and there's 1,000 reasons that's a preposterous headline. So we loaded up and bought in downtown Toronto, right? And I would say several years ago, when things started to get expensive, to give you another example, we used to only buy high-rise projects in the core, right? It was a square, as far north, if you're from Toronto, if your listeners are from Toronto, as far north as Eglinton, as far west as maybe Dufferin, that would be very far, but a really tight square that we call the former city of Toronto, so Toronto proper. And but things started to get expensive even then, right? Affordability was starting to get challenged. So we said, hey, listen, I guarantee you that if we start buying things on a subway line in Bloor West, or at, on the Queensway in Etobicoke, or on the Danforth, where it's outside of the purview of where everybody's focusing today, but I can buy that land for a lot cheaper. And people are going to get to the point where, hey, I can live 10 minutes away on a subway and buy it for 20% less. I'd rather do that. So we started buying land in the Junction area in Western Toronto, on the Queensway, Islington and Bloor, along those transit lines, on the Danforth. And at the time, nobody was looking because everybody wanted to be in downtown Toronto for a high rise. Mm-hmm. And we started doing that, and all of a sudden, that affordability came in very handy because the demand, people got priced out of the core, and they started to say, hey, I can get more for my dollar, either bigger or a cheaper unit of the same size, and I'm a 10-minute subway ride to where I need to go. So that's just another example of going against the herd. So the thing that I would say to people today, and we've done that several times, it's very hard to do, but having resolve in your investment strategy, if you've got the macro right, is what you need to be doing at this point in time, right? You have to be able to see through the fog and remain patient and not panic or get emotional. And the Toronto real estate market, to me, is the most classic example of this. We spent a great deal amount of time today talking about the fundamentals and that imbalance and what's driving price. There's no question in my mind, not a concern that I have, that our market will regain its health some period of time down the road. So if you're an investor today, there might be great opportunities today in this market that you can take advantage of. If you have access to capital, now people have to live their lives, right? You have to plan for the worst and hope for the best. So you have to plan for a period of time where you might need to draw down on some of your savings, or, inflation is causing you to have to erode some of your savings. Whatever that may be, whatever you have left over, you should look at a time like this in things that you have a good macro thesis on and think this is a great time to actually be investing. And that's how we're viewing it. So today, we're going out there and we're as aggressively as ever looking at sites that we would have bought 6 months ago or a year ago. We're being very cognizant of how we're structuring those deals, right? For all the reasons we talked about. And then we're hoping to take advantage of the circumstances to maybe get a slightly better deal.
So technical issues persisted once again, but I want to thank Sasha for coming on Beyond MD and providing exceptional content. I know I learned a lot, and I hope you did as well. Thank you to the listeners as well for reaching out to me and providing suggestions for topics they would like to hear about. That is so appreciated. You can now listen to episodes on beyondmdpodcast.com. A shout out to Arslan Youssef for helping me set up the website. My next goal for the website is to eventually load transcripts of each episode because people have been asking for that. I will get to it with time. And as always, stay well, stay curious, and stay savvy. We'll see you in a few weeks.